Hello, everyone. I'm Amir Marashi, a Doctor of Business Administration candidate and Middle East business strategist. Today is 12th August of 2026 and time about 2 p.m. With Sydney time. Uh, the most important business issue in the Middle East today is still the Strait of Hormuz. The Strait of Hormuz remains effectively close to normal, unrestricted commercial shipping. However, it is not completely sealed. A small number of neutral and especially coordinated vessels are still passing. And the latest maritime assessment describes the trade level inside the Strait of Hormuz as severe. Iran says normal reopening will not happen until the United States accepts its conditions. Iran and Oman are discussing the shipping corridor, but no signed agreement, implementation date, or full reopening has been officially confirmed. This distinction is important. The Strait of Hormuz is not totally empty, but normal business traffic has largely collapsed. Only six vessels passed on Monday, compared with about 130 to 140 vessels per day before the war. Reuters shipping data mentioned about it. And importance of the Strait of Hormuz before the conflict, around 20 million barrels of oil and oil products moved through Hormuz every day. Almost 20% of global LNG trade also use this route. A barrel of oil is about 159 liters. LNG means liquefied natural gas. Natural gas is cooled to about minus 162 degrees Celsius. It becomes a liquid, so it can be transported by ship. The strait is important because Iran is on its northern side and Oman is on its southern side. Inside the Persian Gulf are major energy exporters, including Saudi Arabia, the UAE, Qatar, Kuwait, Iraq, and Bahrain. The main customers are in Asia, especially China, India, Japan, and South Korea. Therefore, a problem in Hormuz quickly becomes a global business problem. Uh, at the latest Reuters market snapshot, Brent crude was about 89.60 per barrel, up to 0.78%. American WTI crude was about 83.94, up 0.89%. Spot gold was about 4,038.7 per ounce, up 0.46%. European gas was trading near 60 euro per megawatt hour, and Asian LNG was around 21.90 per million British thermal units. Bitcoin was around 63 $1,700 to $63,800 and was broadly stable to slightly lower. Brent is the main international oil benchmark. WTI is the main American oil benchmark. A trolley ounce of gold is about 31.1 grams at $4,387 per ounce. Gold was worth roughly 141 per gram before retail fees. Gold increased because some investors wanted a safer place for their money. However, Hormuz is not the only reason. American inflation, interest rates, and the value of the US dollar also influence gold. In Reuters Global Markets mentioned about it, and Bitcoin did not behave exactly like gold. It remained near 63,700 after falling during the previous 2 days. This suggests that today Bitcoin is behaving more like a risky technology asset than a reliable safe haven in current Bitcoin market report. American shares also weakened on Tuesday. The S&P 500 fell 0.32%, the Nasdaq fell 0.60%, and the Dow fell 0.34%. However, the energy sector gained 1.1%. Persian Gulf stock market also weakened. Saudi Arabia fell 0.1%, Dubai 0.4%, Abu Dhabi 0.8%, and Qatar 0.8% in Reuters on global shares and Reuters on Persian Gulf market. Uh, the most important the business equation is revenue equals price multiplied by the volume actually delivered. Profit is revenue minus production, transport, insurance, repair, and financing costs. A country may receive a higher price for oil, but if it cannot export oil, its total income can still fall. Oil that cannot be shipped must go into storage. When storage becomes full, companies must reduce production. This is called shutting in production. The U.S. Energy Information Administration estimated that 5.5 million barrels per day of Middle Eastern production remain shut in during July. Its forecast assumes a gradual improvement from September, but this is only a forecast. This is not proof of reopening. In Iran, the important Iranian companies include NIOC in oil, NITC in tanker transport, NPC in petrochemicals, and IRISL in shipping. Iran has a strategic bargaining power because of its location. It can strongly influence the risk of passage through Hormuz. But this power has a high economic cost. Iran also needs the strait to sell its own oil, petrochemicals, and industrial products, and to receive imported goods. Iran has the Gore Jazz pipeline, which reaches the Gulf of Oman outside Hormuz Strait. Its planned capacity is 1 million barrels per day, but its effective operating capacity is only about 300,000 barrels per day. Therefore, it is not a complete replacement for Iran's main export system. The main Iranian business equation remains Iran oil income equals oil price multiplied by export volume and successful payment collection. Higher prices do not fully benefit Iran when sanctions, the American blockade, insurance restrictions, and payment problems limit exports. Iran may receive a major economic benefit from a wider agreement that releases frozen funds, reduces sanctions, and restores exports. However, continued closure by itself is not a pure economic victory for Iran. In United Arab Emirates and Dubai, the UAE has a mixed position. Abu Dhabi has the ADNOC oil and gas group. Dubai is more dependent on trade, aviation, tourism, banking, property, and logistics. ADNOC can move around 1.5 to 1.8 million barrels of crude oil per day through its Habshan Fujairah pipeline. Fujairah is outside Hormuz Strait. This gives the UAE partial protection. However, this pipeline may be mainly carries crude oil. It cannot solve every problem involving LNG, LPG, petrochemicals, containers, or offshore production. The difference between two ADNOC companies gives us an excellent business lesson. ADNOC Gas reported second quarter profit of $665 million, down 52% because disrupted shipping reduced sales. At the same time, ADNOC Logistics and Services reported profits of $917 million, about four times the previous year. Higher charter rates help its shipping business. A charter rate is the price paid to hire a ship. ADNOC gas result and also ADNOC LNS result mentioned about it, and Dubai's Jebel Ali port is inside the Persian Gulf. DB World has a large international network which gives it diversification, but its local operations remains exposed to fewer ship visits and higher insurance costs. Emirates and Etihad face higher jet fuel prices, longer flight routes, and possible airspace disruption. Emirates NBD, Emar, and other banks and property companies are exposed to weaker investor and tourism confidence. Qatar is one of the most exposed countries because almost all its LNG exports normally use Hormuz Strait. There is no large alternative route for LNG. The key companies are Energy, Qatar Energy LNG, Nakilat, Qatar Airways, Industries Qatar, and Qatar National Bank. Qatar Energy has used force measure on some contracts. Force measure means that an Uncontrolled event prevents a company from meeting all its contractual promises. However, Qatar Energy bought 33 American LNG cargoes worth around $1 billion to support important Asian customers. This was not only an energy purchase, it was also a marketing and customer retention strategy. Qatar wanted to protect its reputation as a reliable long term supplier. The closure also affects fertilizers, plastics, helium, aluminum, airlines, and banking. July Reuters poll forecast that Qatar's economy could contract 8.1% in 2026. This is an economist's forecast, not a confirmed financial result. In Bahrain, the important companies include Bobco Energies, Aluminium Bahrain, Gulf A, and APM Terminals Bahrain. Bahrain receives Saudi crude through the AB4 pipeline. However, this is a supply pipeline into Bahrain. It is not a complete export route around Hormuz. Bahrain's refined products, aluminium, and many other exports still need maritime access. Gulf Air also faces higher fuel and aerospace costs. Bahrain has less financial flexibility than some larger Persian Gulf economies. The Reuters poll forecast a 5.8% economic in 20 contraction in 2026. Kuwait is highly dependent on Hormuz and does not have a major operating bypass pipeline. The main companies are Kuwait Petroleum Corporation, Kuwait Oil Company, KNPC, KIPIC, and Kuwait Oil Tanker Company. Kuwait can produce oil, but it cannot earn full income if tankers cannot safely leave the Persian Gulf. Kuwait Petroleum has estimated that after a real reopening, around 70% of production could return by 6 to 8 weeks. Full recovery would take longer. This means reopening the waterway does not immediately restore normal income. The Reuters poll forecast an 8.1% contraction for Kuwait in 2026, and Saudi Arabia has the strongest major bypass system. Saudi Aramco's east to west pipeline can move oil from eastern fields to Yanbu on the Red Sea. Its maximum capacity is around 7 million barrels per day, although effective export capacity is lower because some oil is used domestically and port capacity is limited. Aramco's second quarter profit increased 44% to $32.69 billion. Higher oil and product prices combined with alternative export infrastructure protected the company. This shows the value of long-term investments in business resilience. The pipeline was built decades ago, but today It is a major competitive advantage. Important Saudi companies include Aramco, SABIC, Bahri, Maudan, and ACWA Power. However, Saudi Arabia is not completely protected. Eastern ports and petrochemical facilities remain exposed to Hormuz. The Red Sea route also faces a risk near Bab el Mandab Strait. The Reuters poll still expected Saudi economic growth of 1.4% in 2026, although this forecast has wide uncertainty. And in Iraq is one of the most financially exposed countries because oil provides most government revenue. The main organizations are SOMO, Barsa Oil Company, and North Oil Company. Most Iraqi crude is exported from Basra and most pass through Hormuz. Iraq has a northern route through Turkey, but its current volume is too small to replace the roughly 3.4 million barrels per day previously exported from the south. When exports fall, Iraq receives less foreign currency and has less money for salaries, infrastructure, and public services. For Iraq, a high oil price is not enough. Safe access from Basra to world markets is the main requirement. Oman has the strongest geographic advantage. Its principal oil and LNG terminals are outside Hormuz. OQ, Oman LNG, and Asyad Logistics Group can continue selling energy without passing through the strait. Sohar, Dug, and Salalah may also receive additional logistics, storage, and transshipments business. Oman can therefore benefit from higher oil and gas prices while maintaining greater export access. Reuters analysis estimated that Oman oil revenue increased 26% earlier in the crisis. The July poll forecast 3.1% economic growth in 2026. Oman also gains diplomatic importance because it is helping negotiations. However, Oman remains exposed to attack in the Gulf of Oman, expensive insurance, and weaker regional confidence. In wider company and industry effects, companies with energy production outside Hormuz may receive higher prices, and these includes American LNG suppliers such as Venture Global and Cheniere, and oil producers with assets in the United States, Norway, Brazil, Guyana, and Australia. This is not mean every international oil company automatically win. uh, EXX on Mobile, Shell, Total Energies, and other major companies also have investments inside the exposed region. Shipping companies may receive higher freight and charter rates, but they also face severe operational and insurance risk. Cargo owners and consumers usually pay the final additional cost. Airlines such as Emirates, Qatar Airways, Etihad Saudi, Gulf Air, Kuwait Airways, and Oman Air face higher fuel prices and longer routes. Petrochemical and industrial companies such as Sabic, SABIC, Baruch, Fertiglobe Industries, Qatar, and Aluminium Bahrain face export problems on certain feedstock supplies and higher transport costs. Banks, property companies, and retailers can suffer from weaker confidence, delayed projects, and more expensive imported goods. Uh, Three business scenarios, if we imagine. In the first scenario, a limited Iran Oman corridor begins operating. Oman and gas export volumes would increase. Energy prices and insurance costs would probably fall, but not immediately return to pre war levels. Airlines, banks, property companies, and Persian Gulf stock markets would receive some relief. In the second scenario, the present restrictions continue. Oil, LNG, shipping, and insurance costs would remain high. Oman and Saudi Arabia would maintain a relative advantage. Qatar, Kuwait, Iraq, and Bahrain would remain under greater pressure. Producers outside Hormuz would continue gaining market opportunities. In the third scenario, disruption expands across both Hormuz and Bab el Mandeb. This would affect the Persian Gulf route and the Red Sea route at the same time. Global inflation could rise further. Central banks could keep interest rates higher. Airlines, manufacturers, consumers, and global stock market would face more pressure. Uh, the market today is pricing a long disruption, but not a permanent total loss of Persian Gulf energy. The strongest companies are not the companies with the most oil or gas. They are the companies with alternative routes, strong storage, insurance, strong cash reserves, diversified customers, and trusted commercial relationships. Iran has gained a strategic bargaining power, but it is also paying a major economic price. Saudi Arabia and Oman have the strongest route resilience. The UAE has partial protection. Qatar, Kuwait, Iraq, and Bahrain remain more exposed. The Strait of Hormuz is no longer only a geographic location. It has become a major variable in company profit, national income, inflation, interest rates, and global investment decisions. This analysis explains business scenarios. It is not an investment recommendation. Thank you for listening to this podcast. I'm Amir Marashi. Have a beautiful and lovely day. See you and take care.